through this act, RBI is going to restrict, or it requires minimum subscription, minimum paid up capital in order to start the banking activities. Banking Regulation Act 1949. So it says private money lender, you are not allowed to lend money for the general public with a high interest. In order to open another branch, in order to open separate branch, again you need to take license from the RBI. Hello everyone, a warm welcome to one and all to the first session on Unit 3, that is Law and Practice of Banking. In today's session, let us start with the Unit 3, that is Banking Regulation Act 1949. In today's session, let us discuss with the introduction, origin, objectives of Banking Regulation Act, then banking sector reforms, last Narasimhan Committee Report 1. So let us discuss all this topic in today's session. So let us start with the introduction. This Banking Regulation Act 1949 is one of the legislative authority of India. It is single body that controls the cooperative and commercial bank of India in all states, including Jammu and Kashmir. So this Banking Regulation Act 1949 is a single act or single legislative authority. It controls all the commercial banks and cooperative banks in all over the country. So through this Banking Regulation Act 1949, RBI is going to control all the commercial banks, all the activities of commercial banks and cooperative banks. So in order to govern, in order to regulate the commercial banks and cooperative banks, this Banking Regulation Act 1949 is going to help the RBI. The Banking Act came into power on the position of the Companies Act with some changes in 1949. So in 1949, with some changes in the Companies Act, they came into power. Next, it came into force from 16 March 1949 and changed to Banking Regulation Act 1949 from 1st March 1966. In 1966, with some amendment, they made some amendment and again they introduced this Banking Regulation Act 1949. So it is applicable in Jammu and Kashmir from 1956. So initially this Banking Regulation Act 1949 is not applicable for the Jammu and Kashmir. After the amendment, it is applicable for the Jammu and Kashmir as well as for the cooperative banks. So initially the law was applicable only to banking companies. Initially this law is applicable only for the commercial banking companies. But 1965 it was amended to make it applicable to cooperative banks. So in the year 1965, they made amendment in order to make it applicable for the cooperative banks also. And they introduced some changes. So they introduced some changes in order to make it applicable for the cooperative banks as well as it is applicable for the Jammu and Kashmir as well as the commercial banks. So in 2020, it was amended to bring the cooperative banks under the supervision of Reserve Bank of India. So in 2020, they made amendment and they made some changes in order to bring cooperative banks under the supervision of RBI. Now RBI is going to control cooperative banks directly. Now cooperative banks comes under the direct supervision from RBI. Moving further, this act provides a framework under which commercial bank in India is supervised and regulated. So this act, this Banking Regulation Act 1949, it gives the framework or it gives the guidelines for the RBI in order to control, in order to regulate the banking sectors. So this act gives the Reserve Bank of India power to license banks and have regulation over shareholding and voting rights of shareholders, then supervise the appointment of the boards and management. Through this act, RBI has the power to license the bank, to give license for the bank as well as to regulate the shareholding and voting rights of the shareholders. Then in order to supervise and in order to appoint the board as well as the management, in order to appoint the board of directors as well as the management or manager, RBI has the right through this Banking Regulation Act 1949. It regulates the operations of banks, lay down instruction for the audits. So this act regulates the banking activity. Then they give instruction for the audits and merger and liquidation and issue directives in the interest of public and on the banking policies and impose penalty. So they protect the public interest as well as they control, direct the merger and liquidation. So they give instruction or guidelines for all this purpose, merger and liquidation. Then they give instruction for the audits and they protect the public interest. So through this act, RBI got the power in order to control, regulate and in order to give instruction for the commercial bank, cooperative banks as well as all the banking sectors in India. So moving further, what are the objectives of this Banking Regulation Act 1949? So it provides specific legislation containing comprehensive provisions particularly to the business of banking in India. So they provide it containing comprehensive provisions for the banking sector as well as particularly for the business of banking in India. They provide provisions and rules and regulation guidelines for the banking sector. It prevents such bank failures by prescribing minimum capital requirements. So through this act, RBI is going to restrict or it requires minimum subscription, minimum paid up capital in order to start the banking activity so that it prevents the failures in the banking sectors. It prevents the failures by the banking sectors. Ensures the balanced development of banking companies. They ensure banking development so that it contributes for the economic development and it helps to maintain the price stability in the Indian economy. So it helps to balance, it ensures balanced development in banking sector. So next, it gives power to RBI to approve the appointment, reappointment and removal of the chairman, directors and officers of the banks. So through the RBI is going to appoint and reappoint, then removal of the chairman. RBI has the power to appoint, reappoint and remove the chairman as well as the director and officers for the bank. So through this act, RBI got the power to appoint and reappoint and remove the chairman. So safeguard the interest of depositors. So RBI is going to look after the activities of these commercial banks and cooperative banks in order to safeguard the customer deposits or customer money, in order to protect the customer interest, in order to protect the customer deposits. It facilitates strengthening the banking system of the country. So through the various facility, they strengthen the banking system in country. So through this Banking Regulation Act 1949, they facilitate, they strengthen the banking system and they protect the consumer, they protect the customer interest, depositor interest as well as they regulate banking activity in India. So next, what are the banking sector reforms? So it contains various points. So let us discuss some of the banking sector reforms. So under that, first one is Societies Regulation Act. Societies Regulation Act in the year 1860. This act allows 7 or more people related to any literary, scientific or charitable purpose to form a society or association. So any 7 or more people related to literary, scientific, charitable purpose to form a society or an association. In order to form society or association, this act allows the 7 or more individuals. It is to promote the formal organization in the country. In order to promote formal organization in the country, in order to help the people, this act allow the 7 or more individuals who are related to this particular sectors to start the society or association. So next one, Negotiable Instrument Act. Negotiable Instrument Act 1881. This act defines and amends the law relating to negotiable instruments like promissory note, bill of exchange and checks. So they amended the act relating to negotiable instruments like promissory note, bill of exchange and check. So next one, Indian Trust Act. Indian Trust Act 1882. This act helps to recognize what is a trust and who is legally trustee by law. and give a proper definition for them. So they define who is trustee. Who is trustee according to the law. For example, private money lender. This Banking Regulation Act 1949. So it says private money lender, you're not allowed to lend money for the general public with a high interest. So only through the registered institution, registered financial institution, or through the bank you need to lend money for the general public. So that you can't charge higher interest and you cannot force them to pay more interest. So it defines, this act defines who is trustee according to the law. Next one, the Bankers Books Evidence Act. Bankers Book Evidence Act 1891. This act allows bankers to use their ledger and books as evidence to show their clear records. Banker can use their ledger and their books as a evidence in order to show as a clear records. So this act allows, this reforms or this act allows the banker to use or to show them it as a record. They can use this ledger and books as a evidence. Next one, Indian Stamp Act 1899. This act is related to the introducing and amending law related to Stamp Act and transaction. Relating to Stamp Act and transaction. Next one, Cooperative Society Act 1912. So this act consolidates and amends the law relating to the democratic and smooth functioning of registered cooperative society. Next one, Provident Fund Act. So this act make it mandatory to provide pension or provident fund to employees on different organizations. So this act, it amended or it is mandatory for the organization, for every organization to provide pension or provident fund for their employee. So next one, Indian Partnership Act 1934. This act clarifies the definition of a partnership between two or more persons who shares the profit of a business run by all or by one person only. So it clearly defines the meaning of partnership. Next, the Reserve Bank of India Act 1935. This act led to the formation of Reserve Bank of India in 1935. Through this act, Reserve Bank of India is established in 1935. Next one, Insurance Act 1938. This act regulates the insurance sector and provides a legal framework, monitor industry framework. So this act provides, or this act regulate the insurance companies and provides a legal assistance. So this is all about banking sector reforms. We have various banking sector reforms. So we have discussed only 10 points. So this is all about banking sector reforms. Moving further, next one is Narasimhan Committee Report 1. So Narasimhan Committee Report 1, 1991. RBI form a committee with the leadership or with the chairmanship of Narasimhan in order to give report, in order to reform, in order to develop the banking sectors. So they give their report in the year 1991. They gave first report in the year 1991 and they suggest some of the improvements, or they suggest in order to improve the banking sector, to promote the healthy development of the financial sector. The Narasimhan Committee made recommendation. They made some recommendation. So what all are those recommendations? First one, establishment of 4-tier hierarchy for the banking structure. So first they recommend to establish a 4-tier hierarchy structure, hierarchy for banking structure with 3 to 4 large banks including SBI at the top. So it includes 3 to 4 large bank at the top position. It includes SBI, 3 to 4 large bank, and at the bottom rural bank engaged in the agricultural activity, so that you can give importance for the commercial activity as well as for the agricultural activity. Commercial activity as well as the agricultural activity. So that is first recommendation. Next one, the supervisory functions over the banks and financial institution can be assigned to a quasi-autonomous body sponsored by RBI. So in order to supervise the supervisory function over the banks and financial institution, in order to look after the financial institution and the commercial banks, the commercial banks function can appoint autonomous body which is sponsored by RBI. Through the RBI, an autonomous body can supervise and guide and they can look after the functions of commercial bank as well as the financial institution. That is second recommendation. Next one, a phased reduction in statutory liquidity ratio. So they suggest in order to reduce the statutory liquidity ratio, in order to maintain the price stability and in order to develop Indian economy. Next suggestion or next recommendation was phased achievement of 8% capital adequacy ratio. What do you mean by capital adequacy ratio? Capital adequacy ratio is a total capital to the risk weighted assets as well as the liability. So in the banking sector, total capital, then total capital, next risk weighted assets and their liability. So you need to achieve 8% capital adequacy ratio between the total capital and risk weighted assets and liabilities. So next one is abolition of branch licensing policy. So they suggested or recommended to abolish or to cancel the branch licensing policy. Branch licensing policy means in order to open another branch, in order to open separate branch, again you need to take license from the RBI. So they suggested to remove or to abolish this branch licensing policy in order to improve the banking sectors. So next one, proper classification of assets and full disclosure of accounts of bank and financial institution. So proper classification of assets. So you need to classify the assets properly. Then you need to disclose the information about accounts, then financial institution. So all these are the recommendation from Narasimhan Committee Report 1. So again it continues. Next recommendation, deregulation of interest rates. So you need to make changes in the interest rate. Next one, delegation of direct lending activity of IDBI to the separate corporate body. So IDBI directly, they have a power to lend the money for public. So delegate the power, delegate the direct lending activity to the separate corporate body. So delegate the power from the IDBI to the separate corporate body. Next one, competition among financial institutions on participating approach. So healthy competition, through the healthy competition you can improve or you can develop, India banking sector can improve and develop. Setting up asset reconstruction fund to take over a portion of loan portfolio of bank whose recovery has become difficulty. So they set up a asset reconstruction fund to take over in order to recover the loans provided for the customer. These all are the recommendation from Narasimhan Committee Report 1. So considering all this recommendation, RBI takes some remedies, banking reform measures of government. So government takes some measures relating to this report. On the recommendation of Narasimhan Committee, the following measures were undertaken by government since 1991. So under that, first one is lowering SLR and CRR. So according to, based on Narasimhan Committee report, they reduces the CRR and SLR ratio. Next one, Prudential Norms. So this Prudential Norm, it includes proper classification of accounts, then non-performing assets. You need to classify performing assets and non-performing assets. This Prudential Norm includes proper classification of assets and NPA and remedies for the NPA. Next one, capital adequacy norm. Capital adequacy norm, capital ratio of capital to the risk weighted assets and liabilities of the banks. So they make a remedies or they take action related to capital adequacy norm. Then deregulation of interest rate. They make changes in the interest rate. Next one, recovery of debt. So in order to recover the debt, they take some action in order to protect the depositor interest as well as in order to protect the banks. So next one, Competition from new private sector banks. Banks were open up for the private sector. Through the private sector, start healthy competition. So it give better results for their customer, and it contributes for the economic growth. So access to capital market, freedom of operation. They remove or abolish the branch licensing policy. Next one, local area banks. So through the local area banks, the local customer can access banking facility and they can get the financial benefits from the LAB. Next, supervision of commercial banks. The supervision of these commercial banks is given for the autonomous body, so which is sponsored by RBI. So according to the Narasimhan committee report, they give supervision authority for the autonomous body which is sponsored by the RBI. So these all are the remedies, or these all are the action or reforms taken by government based on the Narasimhan committee report 1. So this is all about Narasimhan committee report 1. So in the next session, let us discuss with the Narasimhan committee report, prudential norms, then non-performing assets. So all those topics let us discuss in the next session. Until then, keep watching. Thank you.